Elevance Health announced their earnings for the full year 2024. I wanted to take a look at what they announced and update my analysis on this company. I am a stockholder in Elevance and have been growing my position in this healthcare insurance payer. Now, the company announced, and overall, I think the earnings are positive. The company had very good earnings per share as expected. They came in line with earnings and their current year growth looked fine. They increased their dividend just a little bit, which is good. Some highlights that I would put out there on overall cash flow is real positive. For the current year, it was 5.8 billion in operating cash flow, which was better than expected. But they're guiding that next year it's going to go up from 5.8 billion to 8 billion in operating cash flow. That's a big jump up. And I hope Elevance is back to generating really high free cash flow. If that's the case, this stock's really going to go up in value. So earnings per share were good. Cash flow, especially the forecast, looked great. Something that's always appreciated is they rebought shares. They repurchased shares of their stock, which is good. They took some shares off the market, making the remaining shares more valuable. So they're going to have a conference call a little later this morning, and I will be listening to it. Right now, I'm probably an hour and 45 minutes before that conference call. Their earnings per share and their free cash flow forecast look really good, and the market likes what they announced. The stock is up almost 6% in pre market hours. We'll see if that sticks, especially since they're going to have their conference call in about an hour and a half, and they could say something there that really upsets the market and sells off. But for now, it's looking good. Elevance is a big cap healthcare insurance payer, and they have been much larger, and they've had a pullback on their stock, a significant one over time. And so has United Health, which is the leader in the space, the biggest company operating and a competitor to Elevance. The revenue is real high at $174 billion, but their forward PE is really low, 12. That's really low for a growing business. Elevance is growing mid-single digit, and they're projecting that next year they're going to grow high single digit, which is very good. They put that in their earnings. Dividends going up just a little bit, and analysts really believe in the company, as I do. They have a strong buy on the stock, and they think it's discounted by 38%. Elevance, as well as other insurance payers, have been in kind of a year, maybe a little longer, really tough times. They've had shrinking of profits and really an adjusting of their business. And their revenue hasn't been growing a whole lot, single digit. And this is consistent with what they announced in their earnings. They grew at about 3% for the whole year. Now, it's still positive, which is good, but they are guiding that they're going to get back into a high single digit growth rate, which is very good. Historically, their cash flow has been superb, which is why I like this space. See this cash flow here, just superb cash flow. But they kind of hit a wall in 2024, and it'll be good to see them move forward and start generating that high free cash flow. They are guiding that operating cash flow is going to be around 8 billion. So they're going to get closer to this historic rate. And if they overperform on that guided number, the stock's going to just flourish, in my opinion. Their gross margin, and this is a health insurance payer, but their margins are good in general. It's a very well run company. Looking at what analysts have to say about the company, even the biggest bear on the stock believes that the stock is underpriced. They believe the stock's worth $478 per share, but right now it's trading for $390 per share. Interesting. Overall, they believe there's a 38% discount, which is a substantial discount on the stock. Looking at the earnings per share forecast, revenue is going to increase in 2025, again, high single digits, and stay growing, which is really good to see. An insurance company can grow two ways, maybe a couple of different ways. You can grow the number of customers, you can grow the number of products, and you can increase your rates. And I think the rate increases are pretty much a norm. Insurance costs continue to go up. Earnings per share look really good, and they're going to expand faster than the growth in revenue. Very good. So these things look excellent, especially the PE. If you look at the PE rate, boy, this is really low. And I showed that these guys generate a lot of cash. And they're very profitable. So I think at some point, I believe that healthcare is going to be more appreciated by the marketplace because historically it's done really well. And it really serves maybe the investor that's looking for a lower risk investing option. Healthcare really provides that. So it's looking good for Elevance. I updated my analysis on Elevance and updated the valuation that I have on this company. Let me go through that. I'll start with the conclusion, which I believe it's highly discounted by 85%. That's a huge discount. Well, when I go through and look at their cash flows, and they're guiding for $8 billion, and I'm taking away some dollars away for capex, and I get to about a projected free cash flow amount of $6.7 billion in 2025. Then each year I'm going to grow by 5%. After that, I'll grow by 4%. So this is my cash flow forecast for Elevance over the next 4 years, and then the terminal value all years after that. And the intrinsic value, when I discount all those cash flows by 8%, is 162 billion, much higher than the market cap. I add cash and take away debt to get to their equity value, which is 173 billion. The current market cap is only 90 billion. So there's a big discount when I look at the cash flows that this company is going to generate in the future. And this is the principal way that most long-term stock investors value companies is what level of cash is this company going to produce in the future? Then I want to discount that cash. Earnings per share look good using a PE of 18. If they're growing, profitable, they deserve an 18 in my mind. And a growth rate of 6%, which is conservative. They're supposed to grow much higher. Using those figures, I get a 72% discount if I use earnings per share. I blend the two and I get to that 85% discount. That's a very, very good discount. I'm happy to see that the market is pricing up the stock in the pre-market today. It goes to show that investors are seeing these numbers and seeing that they're positive, which is really good. I have been buying into Elevance and will continue to buy shares. I'd like to build a good position in Elevance. Within healthcare, it hasn't been a case of the numbers don't look good. Actually, the numbers look great with Elevance and other healthcare companies. It's just the market is really attracted to technology stocks and other stocks that are really the most popular stocks of the day. And at some point, they're going to turn their attention to healthcare stocks again. And I think I want to really load up on good quality healthcare companies like Elevance. So when the interest returns for healthcare stocks, I'm sitting on really good positions of these quality companies. So that's my analysis of Elevance Health. Good luck with your investments, and please don't treat this video as any financial advice or recommendation to buy, hold, or sell Elevance. I'm just sharing my history, experience, and opinion on Elevance Health. Good luck.